Now, if you're doing 30 June accounts, you've got another 12 months before these standards kick in, but if you've got a 31 December year end, you're in the middle of this process now. Obviously, one of the biggest changes that we'll be looking at is AASB 13, fair value measurement. Now, it's not a new concept, but arguably the standard clarifies some of the things that need to be done around fair values. So it's a single standard, so whether you're doing financial assets or non-financial assets, the standard applies equally, provides guidance on how to determine fair value when required by another standard. And it clarifies those concepts. It brings in a whole range of what assumptions do you need to make. One of the biggest changes is it specifically requires that when you determine fair value, you use assumptions that a market participant would use. So it's not about what assumptions management are using, it's about what would someone that's looking to buy your assets, how would they assess the value of the asset. It also brings in concepts such as highest and best use, and talks about are they physically possible, legally permissible, financially viable. Interesting thing, things like is it legally permissible? Yes, zoning may be an issue over your land, but would someone still buy that land and seek to have it rezoned? What is the realistic possibility of getting land rezoned? It might be something they're prepared to take the risk on and pay for that. Alternatively, if you're a local government and you have land zoned a particular way, if you wanted to sell it, how hard would it be for you to change the zoning before you actually sold it? The other aspect of this is it talks about you must use a valuation approach which is appropriate in the circumstances. So it talks about you can use a market value approach, you can use a discounted cash flow approach, or you can use your replacement cost. In most cases, it'll be fairly simple. So if you've got a road or a bridge, there's no market, there's no income, you're stuck with the replacement cost. But if you have a building, there is the potential that, is there a market value? Could we look at, if someone else bought the building, would they rent out the floor space? So could an income approach be used? Or alternatively, could we also use a depreciated replacement cost? So it's about looking at the various methodologies that could be used and working out which one's the most appropriate one. And the standard talks about use the one that relies on the most observable inputs. So if you're using a lot of unobservable management assumptions, it's probably not going to be the most appropriate. And that flows on to the disclosure requirements in looking at your assumptions and your inputs. And it's moved to the three-tiered approach. So you'd be familiar with that under AASB 7 for your financial instruments. AASB 13 now moves that into all fair value approaches. So for your non-current assets, you look at the breakdown of your key inputs and are they readily observable in the market. You can identify them from reference to a similar asset in the same market, or are they purely management assumptions? And depending on how you value those or how you identify those will depend on the disclosures you need to include in your financial statements. So there's a bit of work in getting an understanding of your values for this year and looking at what the impact will be going forward under AASB 13. There's some changes around AASB 119 employee benefits. One of the most obvious is the definition of short-term benefits. So short-term benefits are now based on settlement rather than entitlement. So it's a short-term benefit if you expect to fully settle that benefit within the next 12 months. So one that always comes up is annual leave. Yes, people are entitled to annual leave, but if you don't expect people to take their annual leave within the next 12 months, it may actually move out from a short-term benefit to a long-term benefit and need to be measured under those requirements of the standard. The other big change to the standards next year are the standards around consolidation and investments in other entities. So there's a suite of 6 standards coming in. So we're basically taking 2 standards in AASB 127 and 128 and making them into 6. Particularly big change, AASB 10 is your consolidation standard. Now the process for consolidating financial statements hasn't changed, but there are some subtle differences around control. We're used to the concept that control exists where one entity has the power to, or the capacity to dominate the decision making in relation to financial operating policies. It's not significantly different, but it's subtle enough to maybe cause a few changes. So it now looks at whether the investor has power over the investee, whether the investor is exposed or have rights to variable returns, which could be both positive returns or negative returns. So if you need to constantly put money back into the entity because it's running a loss, well, it probably is captured there as well. And then it links the two. And it's the ability of the investor to use their power to impact on the returns that they will, those variable returns that they will get. So it is a similar concept, but if you actually start walking through the detailed guidance at the back, you'll find there are circumstances described in there that might make you think, oh, okay, this has changed a bit. And in particular, it talks about things like substantive rights. It talks specifically about the right or the power to direct the relevant activities. So you probably need to look at what activities do you have power over and does it represent control. From 1 July 2013, there's a few other changes, clarifying requirements around comparative information. So it now specifically will refer to a third statement of financial position if you're making a change or retrospectively changing an accounting policy. AASB 124, interestingly enough, it will remove the disclosure requirements around individual key management personnel. One change some of you may already have implemented is AASB 1053, which is reporting by tiers. So it's our reduced disclosure requirements. Treasury have identified in the FRRs that you can early adopt this standard if you are a small statutory body which doesn't get consolidated into whole of government financial statements. So everyone else that the FRRs apply to, departments and statutory bodies, you're at tier 1 requirements apply. You need to continue to prepare full general purpose. The other area where I believe there is some benefit are controlled entities, small controlled entities which maybe prepare special purpose financial statements, particularly things that aren't companies because there are requirements already in place there. It's a better option than preparing special purpose financial statements because it actually provides an appropriate framework. Going beyond that, again, there's some interesting changes. AASB 1055 was released just recently. There's been various versions of exposure drafts around reporting budget information in your financial statements. There is now a standard which will apply in 2 years' time. The good news for most entities, it will only apply to not-for-profit entities within the general government sector and will only apply where the budget is actually tabled in Parliament and it separately identifies the relevant entities. So based on that, the only entities at the moment that would be caught would be government departments. So this would require disclosure of the original budget, basically the budget that's tabled in Parliament, and it requires disclosure on the same basis as the presentation of your financial statements. So it's a new way of reporting, and the big challenge we find with whole of government that do this now is the variances. So it requires explanation of significant variances between budget and actual. So that's a challenge for management and it's a challenge for audit about the level of detail that's required. There are 9 exposure drafts presently open for comment either with the AASB or the international standard setters bodies, and a further 41 exposure drafts that have been issued in recent years which are still identified as pending, which may or may not mean that there's a standard. And I understand that in terms of the revenue standard, there's likely to be a standard released by the IASB before 30 June this year, and the leases standard is likely to have a new exposure draft released before 30 June. So they are still there in the background. One of the other exposure drafts that is pending is the exposure draft they issued on related party information for not-for-profits. So that would extend the information to most government entities. So what should we do for this year? You need to review and assess your impact for the latest standards. You need to be on top of these and start looking now at what's going to change. Can't leave it for next year. It'll hit too hard. In terms of this year's financial statements, you're going to need to update your note number 1. So the standards to be implemented, or standards that have been issued but yet to be implemented. keep in mind that you should actually provide what the likely impact is. Make a genuine assessment. Don't just have the standard statement, yet to be assessed. Revise your valuation process. I think that's the biggest tip I can give. If you're getting values performed this year, have a look at them when you're doing it and say, well, are we complying with AASB 13? What needs to change? Do we need to change any of our assumptions? And probably one of the most important things is, do we have the information available to us to assess what the key inputs are and whether they're level 1, 2 or 3? I guess one of the biggest issues we find with the valuations that get performed are the level of detail from the valuers' reports, and it's often that process when I talked about timing. Based on our reviews of valuers' reports, there is often limited information that they provide. You should be asking for a detailed listing of all their key assumptions and inputs that they've used, because you're going to need it going forward under this standard. The International Valuation Standards Council has a valuation standard 103, which requires valuers to produce a report which provides all the detailed inputs and assumptions for a third-party reader to be able to understand the process. That's what you should be asking for. Now, a lot of them don't need to comply with that because they're not registered with that particular body, but you should be asking for it anyway because it's a better practice guide and it really does provide you the information you need to move forward under AASB 13. You may also need to start looking at your investments in other entities. Are there things that maybe we do actually control under AASB 13 that we haven't previously recognised? Are there things that maybe we're saying now that we control that in fact we won't be controlling under AASB 13? Again, have a look at those sorts of things when you're doing your financial statements this year. And continue to monitor and assess developments. The one I wanted to just touch on finally before we wrap up the session is grant acquittals. It's a big area. They may seem fairly minor in terms of the size. A couple of things to keep in mind. They are separate financial statements and require an audit opinion on them. So even though they may not be material to the larger financial statements of the entity that's issuing these grant acquittals, they become material in their own right because they are actually a separate set of financial statements that audit is being asked to sign off on. And it can also add to the cost of it because we have to do certain things in terms of our audit. The quality, is there a process, I would ask? Are CFOs and CEOs actually aware of some of these certificates? We've tried identifying them, I understand, in some of our plans this year. If there are any additional ones that you're aware of, build it into your financial reporting process because they often get left to the last minute. Audit's already left and then they go, can you come back and audit these? It's not a very efficient and effective way, and even though they may be small, the cost can pretty quickly build up if you've got to come back and do them as a separate process. And the other thing to consider about doing them early is what are the actual requirements? Some of the requirements in the actual agreements can be a little bit unclear. So in that case, you may need to go back to the relevant Commonwealth agency and get some clarification around, well, what are we reporting on? What do you require us to do? Because if there's not a great clarity around the reporting framework, it could also impact on your audit opinion. So what's it all mean? I think it says that the results for 2011-12 were pretty good, particularly given the changes that went on both within local government and state government last year. But there's still room for improvement, and that's both in getting the financial statement preparation and the audit process. So there's still ways we can move to get the process done on a more timely basis.